It's a pleasure to be back with you, and today I want to do something most commentators avoid because it's uncomfortable. I want to explain a crisis without villains in capes, without conspiracy fog, and without the lazy excuse of the market failed. I want to walk you through a simple idea that sounds almost too obvious to be true. The US government, through a chain of predictable incentives and well-intended shortcuts, helped create the conditions for the very financial stress it later claimed to be rescuing us from. Now, quick note before we begin. This is educational commentary, not personal financial advice. My goal is clarity, because if you understand the mechanism, you'll stop being surprised by the outcome, and you'll start recognizing the same pattern when it appears again under a new name. Here's the paradox that should keep any honest person awake at night. The government is supposed to stabilize the system. It writes the rules, funds the regulators, insures deposits, backstops markets, and, through the central bank, manages money itself. Yet again and again, we find ourselves in periods of instability that look eerily similar. Asset prices surge beyond reason, debt expands like a balloon, risk gets mispriced, and suddenly everyone acts shocked when the balloon pops. So what happened? What was the error that broke the system? Was it greed? Was it capitalism? Was it some sudden outbreak of irresponsibility that just appeared one morning? No. The error was structural. It was the belief that you can get the benefits of a market, innovation, credit creation, growth, while insulating everyone from the consequences of bad decisions. It was the attempt to engineer prosperity through cheap money, guarantees, and political credit allocation, while pretending those tools have no cost. In economics, there is no free lunch. You can hide the bill for a while, but you cannot delete it. Let me give you the simplest version of the story, and then we'll build from there. A financial system is like a communication network. Prices and interest rates are signals. They tell people what is scarce and what is abundant, what is risky and what is safe, what is sustainable and what is temporary. When those signals are honest, society allocates resources relatively well. People still make mistakes, but the system corrects them. When those signals are distorted by policy, by guarantees, by artificial interest rates, people make bigger mistakes, and the system corrects them violently. And the most powerful signal in the entire financial universe is the interest rate. The interest rate is the price of time. It tells you what society is willing to pay today to borrow from tomorrow. It guides savings and investment. It disciplines borrowers. It rewards patience. It penalizes recklessness. When the government, through the central bank and the political pressure surrounding it, pushes that price down artificially for long periods, it sends a message to millions of decision makers. Borrow more, risk more. Don't worry, money is cheap. The future will pay for it. And for a while, it looks like magic. Home prices rise, stocks rise, businesses expand, consumers spend, politicians smile at the cameras and talk about progress. But what actually happened is not magic. It is leverage. It is pulling demand from the future into the present, and it is building fragility because debt is not prosperity. Debt is a claim on future production. If you grow future production faster than the claims, you're fine. If you grow the claims faster than production, you are creating a crisis on schedule. Now, if you want to understand how the government provoked its own financial crisis, you have to focus on three ideas: incentives, guarantees, and money. Incentives tell institutions what behavior is rewarded. Guarantees remove consequences. And money, when expanded rapidly, creates the illusion that real resources have increased when they haven't. Let's begin with incentives, because that's where the story always starts. Politicians operate under a simple constraint. Elections come faster than economic cycles. The costs of bad policy often arrive later, and the benefits of easy policy arrive now. That creates a permanent temptation to choose the policy that feels good today, even if it harms tomorrow. If a politician can push for cheaper credit, looser lending standards, or emergency stimulus that boosts growth in the short run, the political payoff is immediate. Jobs look stronger, markets look calmer, voters feel relief. The bill, higher inflation, higher debt service, distorted investment, arrives later, usually under a different administration, and often blamed on someone else. That's the first error. Treating the economy as something you can manage like a thermostat, with quick adjustments and no side effects. But an economy is not a machine. It's a complex network of human choices. And when you interfere with the price system, you don't eliminate risk. You relocate it, you concentrate it, you hide it until it explodes. Now add guarantees. A guarantee, in the short run, feels compassionate. It says, don't worry, we'll protect you. Deposit insurance protects bank customers. Bailouts protect major institutions. Implicit guarantees protect investors who believe the government will not allow certain markets to fail. But here's the catch. If people expect to be protected from downside, they behave differently. They take more risk. They leverage more aggressively. They become less careful about credit quality. This is not a moral judgment. It's a predictable response to incentives. If you tell a child that no matter what happens, you will always clean their room, you should not be surprised when the room stays messy. If you tell a financial system that major losses will be socialized, pushed onto taxpayers or currency holders, you should not be surprised when risk grows in the shadows. And it's not just the existence of guarantees, it's the inconsistency. Sometimes the government lets a firm fail, sometimes it rescues one, sometimes it rescues markets broadly. That uncertainty creates a strange game where institutions try to become too important to fail. They grow bigger, more interconnected, more systemically vital, because size itself becomes a form of insurance. So what do we have now? A system where political incentives push for cheap credit and short-term stability, and where institutional incentives push toward leverage because downside is partially cushioned by expected intervention. Now we bring in the third ingredient, money. When the central bank expands the money supply aggressively or suppresses interest rates below what a free market would set, it can stimulate spending and raise asset prices. But it cannot create real wealth out of thin air. Real wealth comes from productivity, better tools, better skills, better organization, more efficient production. If you increase money faster than productivity, you don't create more goods and services. You create more claims chasing the same goods and services. Some of that shows up quickly in consumer prices. Some shows up first in asset prices, houses, stocks, bonds, and speculative investments. That's why periods of easy money often come with a strange social mood. People feel richer because their portfolios rose. They borrow against rising home values. They spend more. And the economy looks strong. But the strength is partly a mirage. It's not built on higher output. It's built on higher valuations and higher debt. And that's where the system quietly breaks. Not in one dramatic moment, but in a long series of policy choices that teach everyone the wrong lesson about risk. Think about the psychology this creates. If every time markets wobble, the central bank cuts rates, expands its balance sheet, and signals support, then investors learn to buy the dip. If every time a credit market tightens, emergency facilities appear, then institutions learn that liquidity will be provided. If government deficits expand and are financed indirectly through monetary easing, then political leaders learn that spending has no immediate consequence. And then one day, the math catches up. Because the math always catches up. Let's talk about that math. A government can finance itself in three basic ways: taxes, borrowing, or creating money. Taxes are unpopular. Borrowing is politically easier because the cost is delayed. Creating money can be the easiest of all because the cost is hidden through inflation or asset bubbles. Over time, if borrowing becomes the default, debt grows. When debt grows, the government becomes sensitive to interest rates. A small rise in rates can explode the interest bill. So the political system develops a quiet dependence on low rates. Now, the central bank is not supposed to be political. In theory, it is independent. In practice, it operates in a world where political constraints are everywhere. If rates rise and the government's interest expense surges, fiscal policy gets squeezed. Programs get threatened, politicians get angry, pressure builds, sometimes subtle, sometimes explicit, for the central bank to support growth, maintain stability, ensure smooth market functioning. Those phrases sound responsible, but they can become code for something else. Keep the cost of debt manageable, and that's the trap. When the system becomes addicted to low rates, you can't easily return to normal without pain. Every attempt to tighten threatens a downturn. And because downturns are politically intolerable, the response tends to be more support, more liquidity, more stimulus, more easing. That is how you get a cycle where the medicine becomes the disease. Now, when people hear financial crisis, they often imagine a single event: a bank failure, a stock crash, a dramatic weekend meeting in Washington. But the crisis is usually the end of a long process. The event is the spark. The fuel was laid down for years. So what was the fuel? The fuel was mispriced credit, encouraged leverage, and moral hazard, all underwritten by the belief that stability could be engineered without cost. Let's walk through a concrete mechanism that makes this undeniable. Suppose interest rates are held artificially low. Investors, pension funds, and institutions that need returns have a problem. Safe assets yield too little, so they reach for yield. They buy riskier bonds. They fund riskier projects. They accept weaker covenants. They pile into complex securities. They lend to borrowers who would not qualify under normal conditions because the whole system is searching for return. At the same time, low rates make debt service cheap. Households borrow more. Corporations borrow more, not just to invest in productive capacity, but to buy back shares, to acquire competitors, to boost earnings per share. Governments borrow more. Everyone's balance sheet expands. This looks like growth, but it's often balance sheet growth, not productivity growth. Now a shock hits. It could be a change in inflation expectations. It could be a geopolitical disruption. It could be a pandemic. It could be a collapse of a sector bubble. Whatever it is, markets become cautious. Liquidity dries up. Risk premiums rise. Suddenly, borrowers that were barely solvent under easy conditions are in trouble. This is where the government steps in. It lowers rates, injects liquidity, expands guarantees, and rescues markets. Again, in the short run, this can stop the bleeding. But it also prevents the system from cleansing itself of bad investments. It keeps zombie firms alive. It rewards risk-taking. It teaches the market that downside is temporary because rescue is permanent. And the next cycle begins with an even larger pile of debt. That is the self-provoked crisis. Policy that creates fragility, then policy that prevents correction, thereby increasing fragility until the correction becomes unavoidable and disorderly. Now let me ask you a question that most people never ask out loud. What if the crisis is not a sign that the system is failing, but a sign that the system is trying to correct? In a market economy, recessions have a function. They are not pleasant, but they reallocate resources, they reveal what was unsustainable, they force bad investments to be written down, they allow new firms and new ideas to replace old ones. They are part of the system's immune response. When government policy tries to abolish that immune response, to prevent every downturn, to cushion every loss, it doesn't eliminate pain. It stores it up, it delays it, it concentrates it. And then, when it finally breaks through, it's worse. This is why the phrase, too big to fail, should terrify you. Not because you want failure, but because you should never want institutions to become so large and interconnected that their failure is treated as impossible. That is not safety. That is systemic hostage-taking. Now let's zoom in on the US government specifically, because the title we're dealing with is blunt. How the government of the US caused its own financial crisis. The US plays a unique role in the world. The dollar is the primary reserve currency. Global trade, commodities, and financial contracts often rely on it. This gives the US enormous privileges. It can borrow in its own currency at scale. It can run large deficits. It can export inflationary pressures abroad for a time. But privileges create temptations. When you can finance spending more easily than other countries, the political system is tempted to spend more than it should. When global demand for your bonds remains high, you can postpone discipline. When markets believe you will always be the safe haven, you can stretch the limits longer than anyone else. Yet the laws of economics still apply. If debt grows faster than the economy's productive base, the interest burden rises. If currency creation outpaces output, purchasing power erodes. If the financial sector is continually backstopped, risk migrates to places regulators don't see. And that's another critical error, believing that regulation can replace discipline. Regulators try to measure risk, but risk is not a fixed object. It is adaptive. It moves. If you tighten rules in one place, leverage will shift to another. If you make banks hold more capital, risk may migrate to non-banks. If you restrict one product, another emerges with different packaging but similar exposure. You cannot regulate away the fundamental problem because the fundamental problem is the incentive structure created by policy, cheap money, guarantees, and political reliance on credit growth. Now let's talk about the language that keeps this machine running. Governments rarely admit they are choosing inflation. They rarely admit they are choosing currency debasement. They rarely admit they are rescuing the consequences of their own policy. Instead, they reframe. They say they are supporting employment. They are protecting homeowners. They are stabilizing markets. They are ensuring equitable outcomes. Those goals sound noble, but noble language does not change arithmetic. If you suppress rates to make borrowing easier, you punish savers. If you expand money supply aggressively, you reduce the purchasing power of wages. If you bail out large institutions repeatedly, you create a two-tier system where losses are socialized and gains are privatized. And then, inevitably, public trust erodes. Because the person living paycheck to paycheck doesn't care about the technical explanation of monetary policy. They care that groceries cost more. They care that rent went up faster than their wage. They care that they can't afford a home. They care that their savings don't earn anything while asset owners get richer. That's how a financial crisis becomes a social crisis. Not just because of the numbers, but because of the perceived injustice built into the policy choices. Now, if you want to see the error clearly, you have to stop thinking of the government as a neutral referee and start thinking of it as an actor with its own incentives. The government wants revenue. It wants stability. It wants political survival. It wants to avoid pain that leads to unrest. Those motivations can push it towards short-term fixes that create long-term problems. Consider the government's dilemma in a debt-heavy system. If inflation rises, the central bank would normally raise rates. That's the textbook. But raising rates increases borrowing costs across the economy. It can crash asset prices. It can trigger defaults. It can raise the government's own interest expense. It can turn budget deficits into political emergencies. So the policy path becomes narrow. The government, directly or indirectly, needs rates to stay manageable. It needs credit to keep flowing. It needs asset prices not to collapse too sharply, because falling assets can cause banking stress, pension stress, consumer stress. This is why you see repeated patterns of intervention. It's not because policymakers are evil. It's because the system they helped build has become dependent on intervention, and dependency creates fragility. Now let me pull back the curtain on something most people misunderstand. A crisis is not just a collapse. A crisis is the moment when reality contradicts the story everyone has been telling themselves. The story in an intervention-dependent system is, we can have high debt, low rates, stable markets, and steady growth indefinitely. The crisis is the moment the market says, no, you can't. And that moment can be triggered by many things. A surge in inflation expectations, a loss of confidence in fiscal discipline, a sudden repricing of risk, a shock that exposes leverage, a wave of defaults that reveals that many balance sheets were only viable under artificially easy conditions. Once that moment arrives, policymakers face terrible choices. And here is where the self-provoked nature of the crisis becomes undeniable. Because the choices are all bad, precisely because the previous policies avoided small pain. Option 1. Allow markets to clear. Let weak institutions fail. Let bad investments be written down. Let asset prices adjust. Let the recession occur. Painful? Yes, but it restores signals and discipline. Option 2. Intervene aggressively. Cut rates. Expand balance sheets. Guarantee liabilities. Backstop markets. Limit the downturn. But increase debt, distort signals further, and set the stage for another cycle with greater fragility. In the short run, option 2 is often chosen because it looks compassionate and responsible. It prevents visible disasters. It keeps unemployment from spiking overnight. It calms markets. But the long-run effect is that the system never heals. It becomes a chronic patient. And chronic patients require ever larger doses to feel normal. That is how the government provokes its own crisis, by turning the financial system into a political instrument. Now, I want to slow down and make one point so clear that you can't unsee it. When you hear a politician say, we must do something to protect the economy, always ask, protect it from what? Often they mean protect it from the consequences of previous interventions. They are not protecting the economy from capitalism. They are protecting an intervention-shaped economy from the withdrawal of intervention. This is why every attempt at normalization becomes a drama. Every small rate hike becomes a crisis. Every tightening becomes a market tantrum. Because the system is not built for normal anymore. It is built for support. Now people will object here. They'll say, but without intervention, the collapse would have been worse. Maybe, in the short run. But the real question is, why was the system so fragile that it required intervention in the first place? If your building needs constant emergency scaffolding to keep standing, the solution is not to applaud the scaffolding. The solution is to ask who designed the building and why the materials were so weak. Now let's bring this home to the personal level, because a good explanation should change how you see your own life. When government policies keep rates low for a long time, they encourage people to make decisions they wouldn't otherwise make. A family takes a larger mortgage because the monthly payment seems manageable. A company takes on more debt because refinancing is cheap. A city expands spending because borrowing costs are low. A government runs larger deficits because interest looks affordable. This creates a society that is leveraged to the assumption that rates will remain low. Then inflation rises, or confidence shifts, or the global environment changes. Rates have to rise, or the currency loses credibility. And suddenly, millions of people are trapped by decisions that were rational under one set of policy-created signals and irrational under another. That trap is not an accident. It is the inevitable outcome of distorted signals. Now let's talk about the crisis narrative, because this is where the political theater reaches its peak. When the crisis finally arrives, governments often tell the public a simple story. The private sector misbehaved. We must regulate more. We must spend more. We must control more. But notice the pattern. The proposed solution is often the same set of tools that contributed to the problem. More guarantees, more subsidies, more cheap credit, more monetary expansion, more centralized control of financial flows. It's like a doctor prescribing more of the substance that made the patient sick because the patient feels relief for an hour after the dose. Now, some people hear this and go to an extreme. They say, so we should have no government, no central bank, no regulation. That's not what I'm saying. The point is not to romanticize chaos. The point is to understand trade-offs. A safety net can prevent panic. A lender of last resort can stop bank runs. Regulation can reduce fraud. But when safety nets become trampolines, when backstops become business models, and when monetary policy becomes a permanent growth engine, the system will produce bubbles and busts. Not because markets are evil, but because incentives are misaligned. So what, specifically, was the error? The error was treating money and credit as political tools rather than market signals. The error was creating a structure where risk-taking is rewarded and losses are cushioned. The error was turning the central bank into the firefighter for fires that policy helped ignite, and then calling the firefighting proof that the policy was necessary. Now, I promised you earlier that we'd get to a deeper truth, and this is where it comes into view. The deeper truth is that crises are often the only force strong enough to restore reality to a system that has been insulated from reality. When you distort prices, you distort behavior. When you distort behavior long enough, you build a world that cannot survive without distortion. And then you face a choice. Restore reality gradually, or have reality restore itself suddenly. That's why the crisis feels like a rupture. It is a rupture. It's reality breaking through a narrative. Now, what should you do with this understanding? First, learn to recognize the pattern. When you see a policy that offers immediate relief with no visible cost, be suspicious. When you hear promises that debt doesn't matter, that rates can stay low forever, that money can be created without consequence, remember, the cost is there. It's just hidden. Second, pay attention to incentives. If institutions are rewarded for short-term performance and protected from long-term losses, risk will accumulate. If governments can borrow cheaply without discipline, they will borrow. If voters reward immediate benefits and punish immediate pain, politicians will choose policies that create delayed pain. Third, understand that stability purchased through distortion is not stability. It is postponement. And postponement in economics is not mercy. It is amplification. Now, I want to address a common misconception that keeps people passive. People think crises are random, that they come like storms, unpredictable and unavoidable. But many crises are more like engineering failures. They follow from design choices. If you build a bridge with hidden structural weaknesses, it may stand for years. You may even declare it safe. But under stress, it fails. The failure looks sudden. The cause was years in the making. The US government did not wake up one day and decide to create a crisis. But it did build a system in which credit expansion was politically rewarded, in which intervention became expected, and in which the cost of those choices were deferred. And eventually, the deferred cost arrives. Now here's the final truth I promised. The one policymakers don't like to say plainly. A government cannot repeal the discipline of economics. It can only disguise it temporarily. It can print money, but it cannot print productivity. It can borrow, but it cannot borrow indefinitely without consequences. It can guarantee, but it cannot guarantee away scarcity. It can regulate, but it cannot regulate away human incentives. When the government tries to replace markets with management, it doesn't create stability. It creates fragility. And when fragility becomes visible, the system calls it a crisis, as if it came from nowhere. But it did not come from nowhere. It came from the error of believing that you can make risk disappear. You can't. You can only move it. And when you move it into the future and pile more on top, you guarantee that the future will have to absorb it with interest. So the next time you hear someone say, This crisis proves the market failed. Pause. Ask yourself, what signals were distorted? What incentives were created? What guarantees were expanded? What debt was accumulated? What reality was postponed? Because if you can answer those questions, you can often predict the general shape of the next crisis long before it arrives. Not because you're clairvoyant, but because the logic is consistent. And that logic leads to a sober but empowering conclusion. You cannot control the entire economy, but you can control how you interpret it. You can refuse to be seduced by short-term narratives. You can build skills, flexibility, and resilience. You can avoid becoming dependent on a single fragile assumption, like permanently low rates or permanently rising asset prices. You can demand honesty in public policy. And you can recognize that real prosperity comes from production, innovation, and voluntary cooperation, not from printing, promising, and postponing. The error broke the system because it broke the signals. It turned the price of money into a political instrument and then acted surprised when the instrument produced political outcomes. Bigger debt, bigger bubbles, and bigger instability. That is the story. That is the mechanism. And once you see it, you can't unsee it. Many thanks for listening.